What are the Basel Accords and how did they change financial regulation? Imagine a world where banks operate without any rules. It could lead to chaos, right? That's where the Basel Accords come in. These international banking regulations were created by the Basel Committee on Banking Supervision to ensure that banks manage risks effectively and maintain enough capital to cover potential losses. The journey of the Basel Accords began in 1988, with Basel I. This first set of rules focused on minimum capital requirements, mainly addressing credit risk. At that time, there were growing concerns about banks not holding enough capital to absorb losses. Basel I introduced a risk-weighted asset framework, meaning banks had to hold capital based on the riskiness of their assets. This was a significant step toward international banking regulation, and over 100 countries adopted these guidelines. Fast forward to 2004, Basel II arrived. It refined the original rules by including more advanced risk measurement techniques and expanding the focus to operational and market risks. Basel II introduced a three-pillar approach: minimum capital requirements, supervisory review, and market discipline through better disclosure. This allowed banks to use their internal models to assess risks more accurately, creating a more responsive regulatory environment. However, the global financial crisis of 2008 exposed weaknesses in Basel II. It became clear that liquidity and the ability of banks to withstand financial shocks needed more attention. In response, Basel III was developed starting in 2010. This new framework aimed to strengthen capital requirements, enhance risk management, and improve transparency. Basel III introduced higher quality capital standards and new liquidity requirements, like the liquidity coverage ratio and the net stable funding ratio. It also implemented measures to limit excessive leverage and reduce the risk of bank runs during crises. Together, the Basel Accords have transformed financial regulation. They created a global framework that promotes safer banking practices and reduces the chances of bank failures. The Accords encourage transparency and better risk management practices across banks worldwide. From a historical perspective, the Basel Accords mark a key development in regulating the interconnected global banking system. They reflected lessons learned from past crises and show how countries can work together to create standards that protect economies from banking vulnerabilities. The Basel Accords continue to evolve, with updates like Basel IV addressing new risks and refining the regulatory framework even further.